If you're an options trader, one of the biggest things that a lot of people don't understand is Greeks. And if you actually understand Greeks, it's going to make your options trading 10 times better. No exaggeration. Understanding Greeks can be the difference between picking the right contract and picking the wrong one. It can mean the difference between making 1,000% and only 200%. Because each Greek means a very specific thing. And depending on whether you're buying or selling, you need to know the right one to pick for your options trading, especially if you're day trading, but also important if you're swing trading. So the 5 option Greeks are Theta, Delta, Vega, Rho, Gamma. I'm going to say that again. Delta, Theta, Gamma, Vega, Rho. Those are the 5 Greeks of the options trading contract. And I want to break it down step by step in this video. So let's get into it. First thing you need to realize is Delta. What actually is Delta? If you're a buyer of Delta, and even if you're a seller, Delta is the percentage chance, listen to this, Delta is the percentage chance that the stock price or the strike price that you're in is going to get in the money. What does that mean? So for example, right now, XYZ is at $80. If you wanted to buy puts because you think the company is going to go down, well, buying put over here at a point minus 0.04 delta means that there's a 4% chance that this 69 put is going to enter and become in the money, which means it's going to be here. The stock price is going to be at 64 or below at the expiration date. That's what delta means. So if you're a buyer, that means that if you buy this put, that in 2 weeks' time, there's only a 4% chance that this contract is going to end up in the money. That's bad for us for a buyer, but if you're a seller, that's actually a good thing, because now if you're selling contracts, you're selling options contract in premium, you want a low percent chance that it's going to end up in the money, because when you're selling, you only lose money or you get put the shares if the strike price you choose ends up in the money. So what you want as a buyer is a high delta, and what you want as a seller a lot of times is a no delta. And I have literally another video that I break down how to use this to trade as a seller or a buyer, and I'll probably put that below or link that to the end of the video. So you see how if you're a buyer or a seller, the delta means different things and you need to consider it differently. What else does the delta mean? The delta means that for every dollar the stock moves up, your contract is going to increase by price by that delta amount. So let's use the same example of XYZ. Let's say I bought a 70 put. This 70 put right now is $13. The delta is $5. So what does that mean? That means that if XYZ goes from $79.12, whatever it's at now, and drops to $78.12, it loses $1. This contract is going to go from $13 plus 5, that's $18. So the delta is also the amount of money your contract is going to gain per dollar the stock moves up or down. So if it moves in your favor, your contract is going to gain that much. If it moves against your favor, your contract is going to lose that much. That's exactly what delta means. So when you're picking contracts to buy, whether you're buying puts or whether you're buying calls, knowing the delta and how much money you're going to make per dollar move is super important, because not all strike prices are created equal. Sometimes things that are out of the money pay more delta than things that are in the money. So let's look at a perfect example on the call side. From a percentage perspective, if this is $81 and it gains a delta of $26 per dollar it moves up, that might be a 20% increase. I'm just guesstimating here. But if something is $34 and it gains a $13 increase every time the stock moves up, that's almost like a 50% increase. So even though this makes more money, this is actually going to increase your money faster because because the percentage gain on the dollar is more than something that's in the money. And that's why when I swing, I choose out of the money contracts sometimes because of the fact of this very reason. The delta I'm receiving and the percentage increase I'm receiving on my money per dollar the stock moves up in my favor or moves down in my favor, depending if I'm buying calls or puts, is different. So you need to calculate that and put that into calculation when you're picking options to swing. So that's what I mean by if you're a buyer of options and a seller of options, the Greeks mean different things. If you're buying, the delta I'm looking at, number one, the percentage chance, of course, is going to end up in the money. But more importantly, how much am I making per dollar my contract moves up? For every dollar the stock moves up, how much money in percentage is my contract actually gaining? Because what that's going to determine is, hey, the stock might not necessarily need to get in the money. So it's going to choose something that's more out of the money. The delta might be lower. But what's going to happen is, even though the stock moves up $2, $3, $4, $5, it doesn't need to get in the money, and you're still going to make 50, 100, 200% on your money. Why? Because of the delta. So now you're starting to see the importance of these Greeks. Number two, let's go to gamma. What gamma really means is that for every dollar your stock moves up. So let's say your stock moves from $78 to $77 if you're buying puts, right? Or it moves down from $78 to $77 if you're buying puts. The delta actually changes when it moves. And that's the beautiful thing about options. That's why your money compounds and you make more money the more the stock and the option contracts go in your favor. So for example, right now, this delta might be 23, but if this stock goes down, the delta might change from 23 to 33. That change in the delta, because the stock moved in your favor, is called the gamma. So if delta is the amount you make per dollar the stock moves, gamma is the increase or decrease in the amount you make per dollar the stock moves. Is this starting to make sense? So that's what gamma means. Again, I don't pay too much attention to gamma. It's nice to know. I just like to know that my delta is good. A lot of times when I'm picking options contract, and then I'm looking more so at the theta. And the theta actually means that, if we go to this next section here, the theta means that every day your stock gets to expiration, your contract is going to lose that amount of money. So for example, here at the 78 strike price, every day, right, that this option contract go by, Monday, then Tuesday, then Wednesday, every one of those days, this contract is going to lose $10. That's what theta means. If you're a buyer, you need to pay very close attention to this, because theta is going to help you determine if it's moving. If theta is that aggressive, do I want to buy a contract 2 weeks out, or do I want to buy it a month out, or do I want to buy it 3 months out? The more aggressive the theta, the larger the theta, the longer I usually like to buy my contracts out, because the less theta, the better as a buyer. But if you're a seller, you want more theta, because when you're selling options, remember, time works in your favor. When you're buying options, guess what? Time works against you, because when you sell options, you get paid your premium up front. And what happens is, if by expiration, the thing doesn't happen that you placed a trade on, guess what? You get to keep all that premium. As a buyer, it's the opposite. Theta is working against you. You want the stock to move before the clock strikes zero. Again, things to know as a buyer, as a seller. Then the last thing I want to go over here is Vega. Vega is the volatility of these contracts. If the stock is very volatile, then you're going to have increased Vega. If the stock is not volatile, or is not in a volatile season, for example, in earnings season, usually Vega increases. If it's not earnings seasons, you might have low Vega. So Vega just means volatility. So just remember that, beautiful volatility. So how does that help you as an options trader? Great question. If you're a seller of options contract, you want to sell when volatility is high, because premiums are going to be higher and you're going to get paid those premiums, and you want to buy back when volatility is low. If you're a buyer of options contract, you want to buy when Vega is low. That means the contracts are less expensive, and sell when Vega, or you might even call it implied volatility, they're related, when Vega is high, because that means that the premium has increased. So it's that buy low, sell high. It's the opposite. You want to sell high and buy low. So that's why you want to pay attention to Vega. And the last Greek here is rho. Rho relates to interest rates. This is what you need to pay attention to around the time when Feds are speaking, when interest rate and economic data is coming up, because what that judges is the effect of interest rate on the particular stock or ticker. And as you see right now, interest rates are not out, so it's pretty much static. And for a lot of the time, I don't pay attention to rho, and most of your options trading career is not going to need that much of a difference. But the other four, delta, gamma, theta, vega, you can use in your everyday trading and everyday life. So those are the Greeks, and that's how you use them. So just to summarize here, you guys can have a perfect example of this. Delta is the amount of money your contract increases or decreases by dollar the stock moves up in your favor or down in your favor, depending if you buy calls and puts. Gamma is how much your delta increases every time it moves up or down. Theta is how much money your contract is going to lose every day that goes by as you get closer to the expiration of that contract. Vega is the volatility of the stock. The more Vega, guess what? The higher premium prices are. The lower Vega, the lower premium prices are. Rho is the interest rate and how it affects the contracts. So those are the 5 Greeks, and you need to understand them. If you have any questions, answer below. I can do a more in-depth video on this, but that should get you going and start helping you figure out different scenarios. Then you can actually use this in your options trading. So I'll give you a perfect example. If I'm a buyer, of course, I want to look at open interest and things of that nature. The stock market just opened is 932. So let's look at something on the delta side. If I was a day trader and I bought the 81 call here, it tells me that for every dollar XYZ goes up, I'm going to make $37 on this. And look at how it's moving. And as we were moving, it was 37, now it's 41. That's the job of gamma. That's literally gamma at work. A gamma and theta moving side by side as the stock is moving up $1. But something you should notice, though, is that theta is pretty much staying the same for the most part. That's how much the contract is going to lose on the theta. The Vega is the volatility. As you see right now in this stock, the volatility is on the low end. And rho, there's no economic data coming out, so you see pretty much all zeros. There's no effect on interest rate on this particular stock at this time. So if I was a buyer right now and I was day trading, for example, I will be paying very close attention to the delta and the gamma. The delta and the gamma. As a day trader, I'm in and out. But if I'm swinging it, I'm holding it over days, then I want to look at the delta, the gamma, and the theta. I want to look at how much money each contract is going to gain per dollar the stock moves up. I also want to look at, on the gamma side, as it moves up, how much money is my contracts going to gain in delta as it goes in my favor. So for example, this delta is 49, this one is 57. Why? The gamma is 8. Are you seeing that? Because the gamma is the increase in the delta as the price moves up in your favor. If I was on the put side, I'll be losing that delta and gamma. If I was on the call side, because the stock is going up, I'll be gaining that delta and gamma. So those are how the Greeks work. You might want to watch this over and over again till you understand it and use the different examples that I gave you to actually guide your options trading. Hope this video has helped. If you have any questions, comment it down below. And what I'm going to do is I'm going to create a whole worksheet of this, explaining line by line exactly what delta, gamma, theta, vega, and rho is. So if you want that worksheet, just give me your email below, sign up for the free newsletter, and you will get that worksheet delivered right to you in your email, and you can read over it, study it, and have it as a cheat sheet for you when you're actually trading. Other than that, guys, I have some trainings below if you want to check that out, where I teach for 5 days exactly how to use this and how to generate cash flow from trading. I call it the Cash Flow Trading Challenge. And also join the newsletter to get the free Greek worksheet and PDF, like I said, and catch you on the other side.